Hey everyone, this is Kirk here again at OptionAlpha.com, and thanks so much for checking out tonight's video recap of all the opening, closing, and/or adjusting trades. Now, tonight's video, we don't have any opening trades that we entered as new positions today, but we did have a lot of adjustments. And so tonight we're going to talk all about rolling options, particularly rolling spreads, debit spreads to next month, because we have a great example of what not to do and just close out the trade with EWZ. And then a pretty good example with EMC, not a great roll, but definitely a lot better roll than we could possibly do with EWZ. Taking in a 6 cent debit or paying a 6 cent debit to roll isn't ideal. We like to pay around 5 cents or under, so it's just above kind of our rules. But we do want to extend duration on that trade and still want to stay with our bias to the downside. And then obviously we want to talk a lot about UAL tonight. The stock moved completely against us today. We made some adjustments. It still moved against us. We still have time between now and expiration. So I like where we're at right now with the adjustment that we made. It's a very, very margin intensive position, meaning that when I sent out the alert, I even told you guys this is a margin intensive position now. So now we're playing a little bit of defense and we need to bring some money to the table to kind of back this up and turn this trade around. And if we need to roll it to August, we'll end up rolling it to August, whatever the case is. It's got huge implied volatility, so we just can't shy away from this. And this is one of those times where you just have to be a little bit more aggressive in your trading. But tonight, let's first start with EWZ. And we went ahead and just got out of the EWZ call spread that we had for July. And that was the 49.50 call spread for a 26-cent debit. So we took a $21 loss on each of those spreads. Now, the reason that this is a good learning example is because unlike EMC, which is below, which we rolled to August for a small debit of around 6 cents, EWZ, if we actually go to the chart here, you'll notice that, first of all, the stock isn't really anywhere close to our break-even price on our original trade. So our original trade, our break-even price was around 49.50, and you can see the stock is closing about $1, or closed today about $1 below that level. So not even close to where the stock is currently trading kind of on the dance floor of being a profitable trade or not. And if you look as far as rolling a trade, you understand that we have to close out August. So we would pay a 26-cent debit like we did today to close out that trade. But then we would have to pay to reestablish the new position for 49.50 in August of 42 cents. So the net premium to roll the contract from July to August would be about 16 cents. So you can see here that just comparing that, it's just a little bit too much of a debit to roll the spread to the next month. And my biggest thing with rolling debit spreads and rolling them for extra time, so from July to August to get that extra time premium, is I don't want to pay too much for it. And generally you'll find that sometimes you'll pay a pretty hefty premium because your strikes are already too far out of the money or too far in the money, whatever the case is. But sometimes you actually might find that you can pay around 5 cents or less in most cases to actually roll that spread to next month and give yourself a little bit more time. That way you're not risking it on a 1 or 2 day move right before expiration before the thing becomes either very profitable or becomes a huge loss. So I don't like to risk it. And as we get closer to expiration like we're in right now, about 8 days to go in expiration, I'd rather just go ahead and close out this trade in particular if we can actually roll the spread to next month. So for the other adjustment that we made is in EMC. Now in this particular instance, we actually did roll the spread out to August. So we went ahead and did 3 of the vertical rolls in EMC. We rolled it from from July to August. So we closed out July and rolled it to August. And the combination of closing out July, so getting a credit for that spread, whatever was left, and establishing the new position in July was only a 6-cent debit. So you can see a much bigger difference than what we could have had to pay with EWZ. Now with July in EMC, we still have a break-even price around 26.40 or so. I'm sorry, 26.60 or so for EMC. So we actually want EMC to continue to move lower. That's obviously the ideal situation, is for EMC to continue to move lower. And if it does, then we actually make some money. So you can see we're right on the doorstep here. It's a lot different than with EWZ where it was about $1 away. Right now we're about 10 cents away from where we need it to be if it continues to move lower. And we have earnings coming up, so we still could see a move up in implied volatility, which would be really good for the position. But again, very, very cheap roll to extend our duration, extend the time that we have left in this position. All right, so now let's talk about UAL. So UAL is a little bit different, right? We had originally entered a very, very wide straddle in UAL and then had adjusted it and were recently inverted at the 39 call and the 40 strike put. Now, the first trade that we actually made today was to enter a brand new strangle, so increasing the number of contracts that we have in the market and therefore taking in a bigger credit, which you guys know I'm really huge on, is as the market starts to test you on either side, you've got to take in a lot of credit, a lot of credit. And yes, it does start to tie up a lot of margin because now you're starting to take in more credit. You've got more naked options on one side of the market or another. But as we start to force UAL to into this kind of last 7 days or so in expiration, it's going to start to see a lot of massive time decay. So we want to keep trying to adjust our position to both take in premium and recenter the strategy over where the market is trading. So the first trade that we made today was we sold 4 brand new straddles at the 43 strike. This is both on the call and the put side, so it's not a strangle, it's a straddle right over the market. 43 call and 43 put. We did this today when UAL was trading right around 43. And the reason that we did the straddle is because both of those options at the time had really, really high extrinsic value. So it had very little intrinsic value because it was trading around 43, very high extrinsic value. Now, obviously, the stock closed way higher than that today, but at the time we entered this trade, the stock was trading around 43, just so you guys have an understanding of when we placed this trade throughout the day. Now, we took in a nice credit of $2.50 on this, so that technically on this particular straddle moves our break-even point out to around 450. So actually, if we had entered this trade just not doing anything else, this actually still would have been okay, even if the market moved against us, because that big credit that we take in on that straddle, or that big 450 credit that we took, 250 credit, excuse me, that we took in on that straddle, helps move that break-even price on the trade $2.50 out in either direction. Now, obviously, we already had an inverted spread below the market or strangle below the market, so it doesn't work out exactly like that, but it did help recenter the strategy over 43 for the time being. Now, as the market continued to move higher today, what we did is we went ahead and entered a vertical spread to go ahead and roll up our 40 strike puts that we were short. So remember, our original position going into today was an inverted 39 call and 40 strike put below the market. As the market rallied higher, that 40 strike put is now worthless. So we've made money on that side of the trade. And what we want to do now is, again, roll this closer to the market to take in more premium. So we do that by entering a vertical where we sell the 44. So we went ahead and sold the 44 and then closed out of our 40s that we were already short, bought those back. The net difference between buying and selling all of these was a $124 credit on each of those. So again, taking in more credit, widening out the base of this huge, huge strangle straddle that we have on UAL going into expiration. The current profit loss diagram on UAL looks something like this, and let me just actually shrink it down so you guys can see it. But it looks something like this. It's a little bit different just because like it was before, where we doesn't, or Thinkorswim doesn't take into account the credits that we've already received. So we've now at, I believe, 3 options that we have sold and then closed out of and taken in credits. So it doesn't take into account those credits just yet. And it was definitely a very heavy move higher. So we want to see UAL start to retrace some of that move tomorrow for sure. If it does continue to move higher, then we might go ahead and start rolling up some of these 43 strikes that we have up to around 45. Again, just continuing to take in more credit. But right now, or at least at the time that we enter the trade around 43, we had recentered the strategy or the area in which we actually make money right over this 43 strike. So you can see that's the 43 strike, and we kind of recentered the strategy right over there, trying to make the market move, make a move in either direction. You can see it did make a huge move. So now what we've got to do is go ahead and try to roll this up to 45 tomorrow if the market starts to continue to move higher or really just kind of stays there, and then try to recenter this entire strategy again right over that 45 strike so that we have a good opportunity at expiration to make some money. I still really like this trade. It's got a lot of implied volatility and premium that's in it. Implied volatility is up at the 80th percentile for UAL. So even though it's giving us a little bit of trouble right now, I still really like this spread. And if we need to roll it to August to continue to take in more premium and make this trade work for us, we definitely will. I've been in this situation a ton of times. And what I can definitely tell you is that rolling in this situation, as long as you're taking in more credit and as long as implied volatility is still high, still makes sense and ends up usually becoming a very good trade. So that's the whole deal on UAL. A lot of adjusting and movement today with the market. I'm sure that tomorrow will be no different as we kind of head towards the end of this week. But as always, if you guys have any questions or comments on the trades that we made here tonight on the site or any of our trades that we have currently open, please feel free to add them right below here in the comments section. I'll get back to each and every one of those before the open tomorrow, and happy trading.